Hi, this is Pat O'Meara. I'm the chairman and CEO of Inveniam Capital Partners, and we are excited to be here with so many of our good friends and leaders in the tokenization of real-world assets and creation of digital instruments as we change how value is stored globally. And it's really exciting to have so many of our good friends here with us. And today we're going to talk about how do we live and how is value going to be stored in a multi-chain world. And to do that, we brought in a number of fantastic folks from various different chains, as well as Ed from RedSwan, who's going to be talking about how they think about which chain to use and where those markets are going to be and how they're going to store value on chain from real estate. And then we're joined also by Kevin Cuddeback, our Chief Data Scientist. Kevin, you want to give a quick introduction of yourself, and then we'll go around the horn.
Sure. I've been at Inveniam for coming up on 6 years. My title is Chief Data Scientist. I say that my role is sales engineer because my job is to understand how people's data will work on our Inveniam IO platform and work with the many chains that we partner with.
Fantastic. Thanks, Kevin. Sabrina, what a pleasure to have you with us. Thanks so much for being here. Would you mind introducing yourself real quick?
Sure, Patrick. So my name is Sabrina. I'm with the HBAR Foundation. So I help grow the HBAR ecosystem. Specifically, I lead the FinTech and Payments Fund. So I support our startups working on stablecoins, CBDCs, asset tokenization, and so on. Good to be here.
Wonderful. Sabrina, great to have you. Boris, give us a quick introduction of yourself.
Thanks, Patrick. So my name is Boris Spremo. I'm the head of tokenization at Polygon Labs, and my job is to foster the adoption of tokenized financial instruments and any new asset classes that we see on the horizon. That has two parts. Part number one is working with the large institutions and anyone who makes the traditional value chain, and the second part is getting the ecosystem going and thriving on Polygon networks for the actual tokenization tools that the holders of capital and the incumbents can use. Thank you. Pleased to be here.
Yeah, what a pleasure to have you, Boris. Thanks for being here. Paul, tell us a little bit about yourself.
Patrick, thanks for doing this podcast and inviting me. I'm the CEO of a development company, IDD Labs, that Inveniam was instrumental in putting together. And I am the chief architect of Accumulate. Accumulate is a security layer and identity layer on the blockchain with capabilities for driving account abstraction and many other smart contracting platforms. And there's, of course, a lot more to say, but I'll leave it at that.
We're coming back to you, brother. So we don't have to say it all the first round because we want to keep coming back to everybody and enter into a good dialogue. But Ed, why don't you? We want you to be our kind of cleanup hitter here. Give us a quick introduction of yourself and RedSwan.
Hi, yeah, thanks, Pat. Really, always a pleasure to be here. You guys, Pat, you always have the best network of brain trust in the industry, so it's always good to get involved and invited to your events. But I'm Ed Nwokedi. I'm the founder and CEO of RedSwan CRE, and we are a full-service digital marketplace of tokenized commercial real estate. We are operating in both the United States and Africa, and now Middle East.
And it's great to have you, and thanks for the fabulous compliments. So noted, so you'll get invited back. Well done. And Ed, we've been in this for a couple minutes, right? Where we're talking about tokenizing on-chain. What does that mean legally? What does that mean technically? What does that mean in the market? What does the market want from tokenization, right? What's the promise? And then what is going to drive adoption? Who are the early adopters? All of these are various different pieces. Who are the right institutions that are putting inventory on chain? Who are the right buyers? What are the mechanisms to do that? But all of this sits on top of chains, right? And there's just a whole bunch of them, right? And and being men of principle, you know, you and I, as guys who are in the business side of this, we're going to use chains that pay us, right? First off, right? So, you know, as a man of principle, but also we have to use chains that where markets are going to develop, because you don't want to be on an island, right? And how do you think about what chain to use, what chain not to use? And as you think about who you're partnering with from an ecosystem standpoint, tell us about that calculus in your own mind.
Yeah, that's a good question, because, you know, we've been using a few different chains since we started the inception and back in 2018. Of course, you know, cost was a factor when you're using Ethereum. We were really realizing that as we move into other markets and we start breaking down the crowdfunding into lower denominations to make it affordable, you know, does the gas fees, you know, make sense? And that's when we started looking at other chains, layer one chains that actually provide a lower cost. But I think overall we like, you know, companies. I mean, like, for example, Hedera. We really like what Hedera is doing. I mean, Polygon is also great. But I think you know, chains that are really thinking about their customers and their community and how they can help them build wealth and look at other things other than just like building projects or building dApps or applications on the chain, but also the community, how they can really get involved in adding value in terms of investments and building wealth. When we see chains that are really cognizant of that, then we think building real estate on top of those chains makes sense, because it now gives their user base a way to start getting involved in real world asset investments. And I think real estate is a great investment, one of the largest asset classes that people, you know, see every day, touch every day, and can now be involved in. So it also gives, you know, additional use case for the capital these chains provide, their coins. You know, a lot of them are holding on to those coins, but can be converted into the chain's stable coin, which can actually now be used to buy into an asset that was built on that chain. So we're just trying to enlarge the use case for those communities. And so we like, you know, blockchains like even like Polygon, Hedera, who are cognizant of creating that kind of value.
Ed, you've been in this business for a couple minutes, right? In 2018 when you launched, and you know, we've been pushing and grinding, right? And I know that in 2016 I was thinking, am I too late? And in 2018, I'm sure you were thinking, am I too late? Little did we know that we needed 6 years of oxygen to get to where we are today, right? And the reality is this has been a grind. And I think what I want to do is start with Sabrina. Tell us about what got you into blockchain, what brought you to Hedera, and then I think we're going to come back around after this set of questions, and Kevin's going to, you know, kind of pick on you guys and ask you to tell a little bit about your projects. But how did you get into blockchain, and what drew you to Hedera?
So blockchain, first of all, I was the first time I really kind of looked at it from a professional angle. I was working at Samsung, and I was working in health tech, and was looking at the applications of blockchain for health tech specifically, so for securing medical records and things like that. So I didn't really come to it from a trading angle like many people do. And then about a year later, I switched jobs. I joined a company called Line, which is a very well-known messaging app in Asia, and I helped start their blockchain investments. And I led that for 3 years, and we did happen to have some HBAR holdings. I mean, at the time we had a number of layer ones, and I was quite impressed in the Hedera technology. And 3 years later, in 2021, I got the chance to actually join a team out of Asia.
Fantastic. And Sabrina, where are you located?
I'm based in Singapore.
Fantastic. Thanks again for being here with us. Boris, how did you get in? How long have you been into blockchain? What are the functions that you've done, and what brought you to Polygon?
Oh, Lordy, how much time do you have? So the journey started when I was very young, so about 20 years ago, because I was working in tech. I was a technologist, and I was building clearing networks and payments networks. And the first one was in my native Croatia. And then I moved on to UK. I was one of the lead consultants to build Barclays Global Payments Gateway. And then I was the lead technologist on the WorldPay's Global Payments Gateway. And around that time, 2016, 2017, I realized, oh, this blockchain tech actually fixes all the problems that I'm trying to sort out using legacy technology. So after some education, I started managing blockchain innovations BNY Mellon. And after a little while, I started leading it. And that was educational for someone who was purely in technology and then suddenly switched to fostering adoption within banking execs, which led me to co-founding Trustology, Consensus Spoke, backed by 2 Sigma, which is now called Bitpanda Custody. It was a digital custodian regulated in UK and now in Europe. Moved on into the wilderness, done a ton of consulting for policy think tanks, governments, standardization via ISO for tokenized assets. Went into decentralized commerce with Boson Protocol, where I headed up operations and strategy. And we have done a chunky raise, but we have also done metaverse projects, and I have built BD teams that have signed on major brands in 2021 when metaverse was cool and NFTs for physical items were cool. And then I moved on to Polygon, where I first headed up UK BD, but then I came back to my first skill in blockchain, and that is tokenization, because I feel like it's a unique niche, and I feel like we are now at the right time, in the right place to achieve the right results. It's been, to your point, Patrick, it's been a long ride. We've been too early, and it's been a lot of work, but now finally it's being recognized, and we're seeing serious movements across the globe. Yeah.
Yeah, absolutely. And Paul, you are, when I got it in 2016, when I first got into this, I was reading about Factum, and I still remember in May of 17, I had a phone call with you where I was bouncing my ideas off of you and hearing about what you guys were doing with Factum, and boy, I was impressed. You've been in this space for a really, really long time, and I'll credential this by I had breakfast one time with Paul and Adam Back, who I think is from my standpoint the consensus view. If anybody's Satoshi, it's him, right? And boy, he's one of the OGs, right? Very, very OGs. And the reality is, I was sitting at breakfast, and Adam was picking your brain on consensus mechanisms, right? And it was just wonderful with 2 people who've been at this space for a long time. Talk to us about how you got into blockchain, and what led you to launch Factum. You're on mute, Paul.
I think we were all muted.
No, I told myself, don't forget you're on mute, and then I forgot I was on mute. So I started tracking Bitcoin because I was a Slashdot guy back in the day, and Slashdot was a pre Facebook, pre Reddit, pre a lot of things, but after the forums. So, and they still exist today. It's a great platform. But they started that's where the nerdiest of the nerdiest would post things, and people started talking about Bitcoin. And honestly, I don't have a paper trail to know exactly when I started reading about Bitcoin. Probably 2010 and certainly in 2011. So pretty early on. There was a movement in Bitcoin to do tokenization called color coins that sprouted very, very early in the Bitcoin ecosystem. And I wrote some position papers on that, and I just reviewed them the other day. I had not remembered when I had written that paper, and I guess it was in 2012. So tokenization and data on the blockchain has been something that I've been very, very interested in. And the ability to create audits of processes is something that I have focused on. And that led to the development of Factum, and it led to contracts that we had with the Gates Foundation for medical records and with DHS for device security, and even supply chain work that I did with DHS. So I guess the thing that really drove me was this idea that we could create audit trails of transactions and trades in things like crypto, but also everything else. And at the same time, I was an absolute crypto advocate from the very beginning. In 2013, I started a meetup group that I still run, the Austin, I think we renamed it the Austin Crypto Meetup or something like that, but Austin Bitcoin Meetup. And we're largely Bitcoin focused, but also I recognize Bitcoin doesn't cover all the potential use cases of crypto, particularly tokenization, particularly audits of processes. And that's kind of where I'm at.
And this store of value, the changing nature of store of value, right? What was traditionally the ability to own a piece of a corporation that holds physical assets and then funds, and the evolution of, you know, cooperatives to corporations to LLCs to all of these different mechanisms where you could legally own pieces, but then there was a single ledger, right? Whether it's the DTCC or whether it's a book ledger entry using a trust company that would acknowledge your ownership, right? That all of a sudden the ability to have a distributed ledger where we could peer-to-peer trade ownership and trade value, and how do you connect the data from that real world asset to inform that token so that you can understand what it's worth and you can trade it. And for these data-rich, seldom traded assets, and it really is an evolution. And there's all these different chains, and people who want to buy this digital value. And I'm an issuer, right? I own a bunch of real estate assets. I want to tokenize them, and then I want to distribute them. How do I store that value? Where does that value get stored? Am I tied to one chain only? What does that mean? And I think to understand that, we need to understand the chains. And Kevin, I think I'll turn it over to you here, because you were going to maybe ping some people on. Tell us about the different chains that you have and what they are.
Right. I mean, the odds that the first blockchain would get it right on the first try are sort of low. And so everything that isn't Bitcoin exists to do something different and better. And and sometimes it's in the mechanics, the network setup, the underlying consensus. Sometimes it's in the features they support. So I actually just thought it appropriate to ask Sabrina, Boris, and Paul, what makes your chain, technologically different, and what are the features on your chain that you like to talk about. And maybe I'll start with Boris.
Thanks, Kevin. So Polygon Labs, our mission is to create scalability solutions for Ethereum. And what we're known for the best is Polygon Proof of Stake, which is a sidechain to Ethereum mainnet, which is a hybrid plasma commit chain that facilitates really fast deterministic settlement and really cheap transactions with really low latency, which kind of fixes a part of the challenges that the Ethereum had and still has, and facilitates a ton of use cases that we can't necessarily have on Ethereum as much as we love it, because Ethereum is just getting too much love, and that means that it's a little bit too expensive. And if it's too expensive, then any use case or business model, which is sensitive to transaction prices, cannot succeed. And we have managed to become leaders in the scalability space. We have many wallets, many transactions. But maybe, to answer your question, what is important is that we can settle really quickly and deterministically. And when we talk about tokenized assets, most of which are really regulated, deterministic settlement in terms of technology is needed to maintain the settlement in terms of in legal terms, because without it, we cannot have real knowledge of ownership. If there is discrepancy between the two, if the network does not support legal settlement as we wanted, we introduce settlement risk, and that is, that runs counter to the whole point of having blockchains. So that's why we're seeing.
Would you say Polygon is a blockchain just with bigger blocks and shorter block times? Is that how you
actually
do it?
I don't know what the block size is, to be honest. Certainly block times are shorter. They're 2 seconds on the sidechain and 90 seconds commits to the mainnet. At the same time, we are leaders in the zero knowledge space, which is this magical cryptographic concept where I can prove something to Patrick without actually disclosing any material information. So Patrick has the assurance that I'm, for example, a qualified investor without me disclosing anything that would get me into trouble. But also you can confirm transactions.
Hey, Boris, but I want to do two things because we have a lot of people listening, and you've used two terms that I'm going to kind of dial back on, right? Right? And zero knowledge proof is me walking into a bar, them looking at my white beard, and not needing to ask for an ID, and I get served, right? There's no leakage of data, but I walk in with my son, they ask for his ID, and he's leaked his age, his address, et cetera, right? And so a zero knowledge proof is, how do you deliver convincing evidence that you to the truth of something without leaking any knowledge, right? And in a form of attestation, that can be about state of data, origin of data, identity of the your counter. Finality of settlement. What does that mean when you think about finality of settlement? That is legally binding. I can give my own example if you want, or I can turn it back to you. But what when somebody hears that who's not deep into the weeds about finality of settlement, why does that matter?
So let's say that you and I want to trade, and we want to trade on public markets, and you have Apple shares and I have US dollars. So we go to a trading venue, whatever that is. It might be an OTC desk, it might be an exchange, we go by our brokers, and we agree on a price. And I don't know you, and you don't know me, but we agree on the number of units and the price. And that means that we have agreed to do some sort of business. That exchange is called, in the tokenization space, but also in the legacy capital markets, delivery versus payment, which is what we call the settlement process. So everything that happens after the trade has been agreed is the settlement process. In the legacy world, that takes up to 1 day or up to 3 days, depending on the asset, which means that we don't necessarily achieve the same efficiency of capital that we would like. And at the end of that process, that is managed by a number of intermediaries, we are assured, both you and I, that the trade has actually happened how we agreed. So I have received your shares and you have received my money, and that is now fully committed, and there is a public record of ownership, and that is all okay. Or the trade has not happened at all. So it's either 100% successful, atomic, or unsuccessful. Now, these things are done using databases. And traditional databases have an arbitrary change of information. However, blockchains have that change of information, which is subject to consensus, which means that it takes a little bit more time. Because it takes a little bit more time, and because it is for public networks, it is transparent, immutable, open to public scrutiny, and also open to incentives. That means that we need to wait for a little bit. And in quick networks, such as Hedera or Polygon and so on, these things happen very quickly. The point is the same. When the assets change hands, it needs to be done irreversibly and irrefutably so.
And we're gonna talk about financial settlement, right? Because legal settlement, in a bankruptcy, unless you're using in an exchange, that's the difference between centralized and decentralized, where you have legal finality as well as financial finality. But on blockchain, where the value and the security are on the same chain, and you're not using two different systems, right? It used to be that we had to use a system like DTCC and then the wire system and synchronize those two things and prove that the two systems happened. Whereas on blockchain, you can do it instantaneously, which opens all sorts of opportunities, right? and Sabrina, Kevin, I'm jumping.
Yes.
all
Well,
over you,
okay.
brother.
So,
Sorry.
Pat, you're describing a process by which we hope that these things happen in the same block on a linear blockchain. And saying that my block times are fast is a way of saying that I reach, that I'm going to deliver you a consensus on something that happened in this linear chain. Hedera is instead of being a chain of blocks, is a graph of hashes. And so it's going to reach, consensus is going to mean something different. And I'd like Sabrina to talk about what it means to be a graph of hashes instead of a chain of blocks.
Yeah, so we technically Hedera is a decentralized ledger technology, which is a bigger category than blockchain. But essentially, the hash graph was invented to solve that blockchain trilemma, right? That trade-off between throughput, security, and decentralization. So in terms of design, the block design was abandoned because it was deemed to be slow. Instead, so we have nodes, right? The validators are called nodes, and they receive messages independently. And they broadcast the messages to each other, all in parallel, right? So for those messages to not get lost or out of order, every time they receive a message, they will hash and timestamp. Another, so that's a gossip about gossip, because they receive and then they broadcast. And the other, I would say, innovation is that there is no leader node. There is an algorithm that observes those node interactions, and then once a message has been seen by 2/3 of the nodes or more, validates automatically, which means it's highly secure. If you wanted to attack the network, you would have to spam all of the nodes at once, which gets expensive. So with that, yeah, we're not a layer 2. We're not a side chain. We don't really tether back to a layer 1. We're really just an independent network that has a relatively different way to get to consensus.
And one of the reasons we Inveniam, we work with Hedera, we work with Polygon, we work with and sponsor Accumulate quite a bit, right? So we work with all of you guys, but one of the real, I would say, takeoff moments for Hedera is when you became EVM compatible, right? And that was a major distinction. We're talking about interoperability. What was the decision for you to become EVM compatible in order to survive and thrive, right? Because you guys, there had been some, I would say, entropy that had happened, and then once you did, man, just Hedera went through the roof, right? Talk to me a little bit about that and the decision to become EVM compatible. Sure.
The consensus itself, very fast, 10,000 TPS. So a lot of applications could already be supported with the consensus service, and then later the token service was released as well, where you could issue tokens, fungibles and non-fungibles, without relying on smart contracts. The decision to add smart contracts was to help bring additional programmability, as well as additional compatibility with EVM native chains. I think we acknowledge that the ecosystem, historically has been very strong on the EVM chains, and it really, I think, just made it a lot easier for builders who have experience on EVM chains to come over to Hedera and actually try out, the technology without having too much of a learning curve. But I think overall, we could cater to both sides, right? We could cater to Web 2 developers because our SDKs, you could just use JavaScript, and not, you don't really need Solidity unless you want to build smart contracts. And on the other end, if you have done all of your work in Solidity, then you'd be able to also find a home on Hedera.
And thank you, Paul. Talk to us a little bit about Accumulate. What is Accumulate? Is you know, you started with Factum and then Accumulate was created. What is Accumulate? How does it work? And what are the kind of unique attributes? Oh, you're on mute again, brother.
Still muted.
Focus in the right place.
There you go.
There it is.
Bingo.
All right, guys. I'm gonna work on my mute button capabilities. So Accumulate looks at the fundamental problem that most blockchains have, which is the ability to collect data and validate data sets for making decisions both on blockchain and off blockchain. And that naturally flows into the ability to identify actors in a particular process, which puts you in the need for a digital identifier or a digital identity. And so we reorganized the blockchain around digital identifiers, and we call those accumulated digital identifiers because AIDs, because the W3C digital identities are the foundation of what we built, but they lack some features that we wanted in terms of being able to rotate your keys, allowing a digital identifier to act as an authority in another digital identifier, and all of these kinds of architectures. In other words, we needed a blockchain to be able to model the decision making that occurs in the real world every day.
And those are things like decision rights, etc. Is that right?
Anonymity was hot stuff on Slashdot, not so much in financial markets.
Well, exactly correct. And we don't really lose the ability to integrate zero knowledge proofs in the future for anonymous decision making, and we don't eliminate the ability to have an identifier that is difficult to associate with an actor in the real world. By the way, that last feature is the anonymous feature of Bitcoin. You have an address, you just don't know who controls that address, and that's supposed to make you anonymous. But as we know, with coin analysis and with blockchain sleuths that exist, it's very, very hard for an organization to be anonymous on Bitcoin. I would say within weeks of the ETFs being approved and beginning to accept participants selling shares, all of the Bitcoin addresses for all of the Bitcoin ETFs were identified and published. And this is really key. We say you want to have proof of a transaction. Well, the ledger in Bitcoin is open, and it's open to anyone, and the audits can occur whether people want them to or not. If I want to audit the DTCC, good luck. I don't get to. In fact, I'm not really sure who does. So this is where we're going to fundamentally change the tokenization of real estate, tokenization of securities, tokenization of all these real world assets, is that while we need centralized parties to provide a whole bunch of services around the trades of assets, we would like to have a ledger of what has been done that nobody gets to play with. And that's the hope of of tokenization and what we're talking about. And what we did in Accumulate is focus on that. How do we create that ledger? How do we create the definitions of participants? How do we just make this human accessible? So last point I'll make here is all transactions are local to a ADI, a Accumulate Digital Identifier. And that means that you don't need the entire blockchain to audit what decisions an ADI has made. And if that ADI is participating in the control of another ADI, you only need those ADIs to validate and verify every transaction they're making. So even as our protocol may grow to hundreds of terabytes or even petabytes, you'll still be able to have a cryptographically provable audit of what you're interested in that fits on your smartphone. And this was the big goal. How do we create these proofs? How do we make them accessible? How do we make them understandable to the users without a third party to interpret it for us and tell us what has been proven or not, so that I have that third party I'm trusting?
And I think this gets to the heart of, and Ed, I'm going to throw this to you. This gets to the heart of what blockchain settlement, security, decentralization was going to do, which is how do we move value globally in a networked, viral manner in order to aggregate liquidity across silos and have people able to access investment opportunities and store their value in a way that persists beyond a political environment, right? Or a monetary environment where somebody is printing money ad nauseum, right, and inflating away, cash savers' wealth. And Ed, you started here in the U.S. and then you went to Africa, and now you're in the Middle East, where I'm sitting today in Abu Dhabi, and you're literally creating markets in these different geographies. And the goal is to aggregate liquidity, right? And allow free-flowing liquidity and savings in assets that are not going to be deflated or that are going to inflate with their local currency, right? So that they can feed themselves and they can save and store value and grow wealth. Ed, talk to me about, why did you go to Africa? Why did you go to different markets? And what are those market participants want that you're delivering to them in tokenization and stored value, right? What are the drivers as you aggregate liquidity?
Well, Pat, I'm glad that you are in Abu Dhabi and not in Dubai, so you would need a canoe if you were, obviously, with all that rain. But appreciate the question. I think that first, that most of the other countries that we are in are really looking for value globally. They want to have visibility. Think about Africa, for example, and the Middle East. How many Americans know about the high quality commercial assets that are income producing throughout the country, the continent of Africa? And how many know about the same type of opportunities throughout the different countries in UAE or GCC? Very few, because very few platforms have that opportunity where you can see apartment buildings in New York City versus apartment buildings in Abu Dhabi or in Lagos, Nigeria. And so we think bringing that kind of a marketplace to the world is very important, and allowing them to be able to choose also the denominator of returns, whether it be dollars, US dollar backed. This is very important for countries like in Africa, where you have hyperinflation. To be able to buy a US dollar denominated asset in the United States is paying them out dividends in dollars at 8-10%, whatever that might be, how that can offset the hyperinflation they're having in their market. So just to hold their currency steady so that it's not losing value on a various basis is very important. But the other aspect I think is important for all the chains, and very important for what we do, is regulation in all these different markets. And blockchains have to be very aware of the regulatory factor, because that scares off a lot of participants if you're not following a regulatory regime. And I'm very happy to say that as of the 15th of April, that RedSwan is now a FINRA member. We're a U.S. regulatory approved by FINRA and the SEC, which is a big deal for us because it took 2 years to get there. But it now sets us at a stage where we can now really interact with the largest of the largest institutions in terms of their ability to do treasury management, as well as the sponsors in various countries to know that they're being handled in a regulatory framework that follows that of the SEC in the United States. And I think most countries around the world, at least the more stable countries, are following the same kind of jurisdiction and framework for compliance from the SEC. And those who are starting to establish a framework for compliance are looking at the SEC as a way of putting the framework together. So I think that's a very important way of distributing the value that we're talking about. And this is something that's very important to us.
Yeah, and I'm gonna give a commentary on that, Kevin. I'd like for you to weigh in, and then I'd like to all three of the chain sponsors to speak to this. Is one, as Kevin said, Bitcoin got started, and there was an idea of color coins, and there's now ordinals, which are, in my view, a denial of service attack on Bitcoin and their core function, right? And merge mining gives you an opportunity to create these different things on Bitcoin. But the reality is experimentation, it causes the ability to innovate at scale, at speed. And even though these public chains are visible and you can fork them and go create immediately another version of Bitcoin or Bitcoin Cash or whatever with some little tweak to it, the saying is you can fork the technology, but you can't fork the community, right? And the communities around the chains are the development of the chain. And so my question to all three of you is, as you have these communities, yet value is going to flow between chains and interoperability, what does that do to the context of community in which you're trying to build something that is unique to your own, but that there has to be some interoperability? And how does that get you to think about who your partners are, who your community is, as we live in this multi-chain world? What does that mean for community, right, in a multi-chain world? And Boris, can I give that to you first? Or Sabrina, you went
absolutely. Thank you. So we need to have all of the ingredients necessary to do business. And to Ed's point, that was going to be the assets, the originators, the trading venues, the market participants, the investors, the whole value chain, and it might be a little bit compressed. So they can access chains directly if they want to do that. They can access chains indirectly through different tools or through intermediaries such as brokers. And in a growing world, and this is the real answer to your question, Pat, we're not going to see any one chain serving everyone. It is a nice vision, but it's a simplistic vision. So we're going to see different chains emerging in different jurisdictions for regulatory reasons. And the regulator is not going to want the commingling of assets and funds and investors from different jurisdictions. And yet the assets from that particular chain will need to be somehow connected to assets on another particular chain to have truly global markets. So for that, we can use any kind of bridging, and bridging is a different topic, but we need to be able to connect. So I believe, to give you a more succinct answer, I believe that we're going to see atomic communities and atomic value chains occur on any one chain, such as Hedera, Polygon, Ethereum, and so on and so forth. And then we're going to see convergence. So we're going to see growth and appetite, and growth begets growth. Growth in a particular environment is going to attract more assets, more participants, and so on. However, some of them will not be able to access directly for technology reasons, for regulatory reasons, for any other reason. So we're going to have almost like an internet of blockchains. And I'm going to pause there. I could tell you exactly how we're positioned to do that, but I'll abstain. Yeah.
No, that's a great response. Sabrina, please, you chime in as well.
Yeah, I mean, I agree with Boris. Obviously, having the entire value chain, in a given ecosystem, and it really does facilitate builder's life, right? Patrick, you said it's hard to it's easy to fork a chain. It's harder to fork the community. Very true. I would also add it's also hard to fork the governance. Right. In the case of Hedera, the governance is always usually been quite appreciated. I would say, in particular by financial institutions, because we are a permission network, public but permissioned network, and they tend to like that certainty of we know exactly who's running the nodes, which country they're located in. That's something that, in terms of compliance, that's always kind of it ticks the box for financial institutions. And
Sabrina, can I dial in on that just for a second? Because I want you to say more on that. Right? We literally, I was trading emails with the president of a bank in North America, the North American branch of one of the top 10 global banks, and he was conflating public versus private as it relates to nodes versus permissioned and public as it relates to utilization and users of a chain, right? And a lot of people who use these terms, they conflate who the nodes are versus who the users are that can utilize the chain. And I want you to dial in on that, because you have a public chain, but everybody who's processing them, specifically. But that's very different than like Bitcoin, where anybody can become a node, right?
That's right. So, and I guess I don't blame that person for conflating, because there's no real standardized nomenclature. Actually, we say permission for the node operation, and public, because the data on the network is public. You're able to just go to an explorer and see what's going on. So that's how we define it. But I'm aware that not everybody in the industry is kind of using it that way.
Yeah, and it really is interesting, because I'll use Polymath as an example, right? They have anybody can be a node, but only certain people can use the chain unless you're permissioned on, right, as an AML KYC, right? And all these different people have different permutations, and we use the terms a little bit interestingly, and so our lexicon needs to conform, right, as we begin to do this, so we can talk about this, where we're connecting up and interconnecting the chains and the function and the utilization. But Boris, really, to what you had said a moment ago, there's going to be chains that have full ecosystems in jurisdictions, and we need to have that mechanism to connect. And we're, right now we're working with Sabrina and one of our other partners, tokenizing real world assets inside Gift City, where there's going to be a tokenization of an asset, working with the regulators on Hedera in India for tokenization in a fully regulated manner that's there, that we are going to want to connect that up through a superstructure up above, in order, if somebody wants to risk on India and risk off London, how do they do that atomic settlement on that connectivity? Do you know what I mean? Where they already own a token of London real estate, and they want to risk that off, and they want to risk on India, that sits on Hedera natively. Paul, what's that going to look like as people want to go chain to chain to chain to chain? And what are going to be the mechanisms that we facilitate that happening?
Well, it's an interesting question. I mean, the facilitation of communication between the blockchains, generally speaking, does involve bridging, which does involve having perhaps validators that are translating what's happening on one chain to another and bridging that data. Chainlink, for instance, is a protocol to translate market data into other blockchains. I think that what we did with Accumulate is we made it very, very simple to create cryptographic proofs of data, and even to create a cryptographic proof of a data set. And that means that we facilitated the ability to move data into other blockchains. And furthermore, everything within Accumulate is a URL, and we have aspirations of becoming a first-tier internet protocol in order to facilitate the communication, not just between Accumulate and other protocols like Hedera or Polygon, but also between Hedera and Polygon, as well as organize the identities of the parties involved in the translation of that data, or bridging of tokens, or account abstraction, where the actual driver of a smart contract in one protocol exists in another protocol. That allows, once you've done that, that allows the ability to manage your security in one place while driving activities in other blockchains, which means if there is a security issue and you need to retune your security, you would be able to do that without spending gas over, let's say, 15 platforms, if you had assets in 15 platforms. This is a big need in the protocol that in the crypto space that Vitalik has made a big deal with.
Yeah, and when we talk about account abstraction over many chains, this is a really big deal, right? And it creates huge opportunity, right? And without creating risk from a bridge to bridge to bridge to bridge, structure. And that's really important. We have 9 minutes left, which is shocking that we've been on here for 51 minutes. I probably have spoken at least 10 minutes longer than I needed to instead of listening to you guys, so I apologize. But Ed, I want to go through, we're going to kind of ask everybody one more question, do a speed round, 2 minutes per. And Kevin, I'm going to give you kind of the closing commentary for today. But Ed, I want you to talk to me about this, where we think about people trading real value that represents ownership of a real world asset, connecting that data up to an instrument on many different chains, right? What does the future of this look like as your clients are going to own assets that sit on one chain or many chains? How do you think about that? And by the way, should they know or should they care what the chains underneath them are, as long as it works and their wallets contain the value that they're seeking to store and they can trade it on and off? What does that look like from your standpoint as you want to build something that gains adoption with users directly?
Yeah, that's a good question. I think that from our standpoint, we first of all want to work with chains that actually provide the services and the usability that we think is beneficial, as well as have a broad audience which can appreciate the content that we're providing. But we're really chain agnostic. There's not a way you can tie yourself to one chain and sell the largest asset class in the world, because I think some people come to us and they want a chain. They say, hey, I heard such and such about Polygon, I want to use that, or I love Hedera, I've been following them forever, I wanted my asset on Hedera, is it possible you can mint? So we're getting these kind of requests, and we're actually minting on a couple different chains right now. But eventually, it's chain agnostic. We want to make sure that whether it be Polygon or Hedera or Polymath, that we can actually be interoperable through our system on either and all chains. So we can mint on a particular chain, but at the end of the day, not many people care what chain they're on. They just want the end result. I'm buying an asset, you're selling me an asset, which is a digital share of equity or debt on a property, and I want it in my wallet. And then if I want to sell it, I want to be able to come back and be able to sell it. And they can care less about the underlying technology. I'm really happy that we're having this kind of in-depth conversation, because it shows that a lot of thought and concern is going into these blockchains to make sure they can provide that kind of user-free service where they don't have to know really what they're doing. It just happens like it would in the real world, which I think is very important. But we do make sure that if we're going to start working with different chains, that our technology will be able to interact with each one of the chains in terms of the minting, the issuance and also the secondary liquidity of those assets that is really chain agnostic, because we have already built technology to communicate with those chains. So that's how we look at it, more of a global aspect, but also multiple chains. And I think, Chainlink is doing a great job by trying to have that CCIP where the information can easily be read, understood, and integrated. And we think that makes a lot of sense. But starting off, working with chains that actually meet our goals and our objectives is what we're looking for.
And those goals of surety as well as utility, right, and functionality, so that what is there for your end users, I think are some of the key traits. And I'm gonna say, Boris, when you think about Polygon, what are the key traits you want your users to walk away knowing that they've got, right? What is it that when they go to Polygon, they go, I get this here?
Okay. So it's almost like all the basic ingredients to have successful markets. And that is first, the cost, the speed, transparency, the ability to prove something without disclosing any material information, which is zero knowledge that you mentioned, the ability to run fully compliant environments, i.e. their own rollups and validiums, that are compliant with any regulatory environment, which means that the operator can use their own gas token, they determine who transacts, who deploys code, they have full control of the environment, and yet they benefit for liquidity aggregation through the use of zero knowledge proofs with any compatible network. So it's almost like having all the benefits of private networks, which we've been trying to avoid as a community for the longest time because we don't believe in them. However, they are needed in traditional finance with all the benefits of public networks, which is the abundance of community, liquidity, assets, and scope. So I think I will pause there. All of the ingredients are there, and I'm happy to talk to anyone really. But I think this is what I would like, to conclude.
That's excellent. That's excellent. These are not simple conversations. There's so much, and I know that having this many people on for just an hour, it might be one-on-one conversations where we could just plumb the knowledge of each and every one of you for that full hour. But Paul, come to me with your view. What is the unique contribution that Accumulate and Acme that you created, that you wanted to deliver to the market, that you say this is what we're doing that is additive to the rest of what the market has?
Well, I think that the number one design goal of Accumulate is to accommodate selfishness. When you go to the blockchain, you need to see what you care about. And you need to be able to see the cryptographic proofs of what you care about. You don't care about what other people are doing. Just like when you go to the bank, you're going to send a wire to us because, of course, you want to invest in us. And you don't care that your neighbor, Joe, is fiddling around with Fidelity or something, and that's not your transaction. Your transaction is your wire. And so the blockchain should act like that, not just act like that because the browser you have only gives you a certain amount of information, but because the cryptographic proofs that you're pulling from the blockchain are proving that your data and your interests are correct, and the transactions are correct, and the transactions are complete, and your wallet doesn't have to pull all that other information. If you want a legitimate validation of Ethereum on your machine, you need to run a full Ethereum node. That's a problem.
That's heavy.
What's that?
Yeah, that's heavy. That's a
heavy.
lot.
That's too much. And same thing with Bitcoin. For most of the blockchains, this is true.
And that's a blocker for decentralization. And we're coming up on the end, Paul, and I don't mean to cut you off, but I want to come. Sabrina, tell us about, from your standpoint, what are you adding to the global decentralized store of value that Hedera is delivering that's unique from a selling proposition?
Right. So, as I mentioned earlier, different user profiles come for different things, right? So for builders, it's mainly what are the building blocks out there that I can leverage? Is there the whole value chain that can I tap into another marketplace? For example, if I'm an issuer, where can I list? All that stuff. That's kind of table stakes. But then if you look at maybe financial institutions, they have their own ecosystem. They don't necessarily rely on that so much. But then the things that matter more are do I have granular controls? Can I freeze an account? Can I wipe a balance? So you can actually do all that using the Hedera token service, which so that kind of immutability of blockchain, can get in the way of compliance. So with that, I think this is kind of a unique value proposition that makes it easier to issue tokens on Hedera. Another interesting aspect, it is very payments friendly because of the high throughput and the very low cost, and the fees are actually priced in USD. So if you're going to have high throughput operations with a lot of trading, that matters. You want some visibility on how much it's going to cost. And lastly, also the carbon footprint is very, very low on Hedera. It's the greenest chain out there, and bringing capital markets on chain, we're also bringing ESG assets on chain, and that's usually a very important consideration for anything that's a green project, a green bond, carbon credits and such.
Yeah, that values that matters to people. They just put a lot of value in that. Ed, go ahead. You want to make a comment?
Yeah, I'm just saying this is great content, but I think at the end of the day, the users out there, at least the thousands of users we have on our platform, are trusting the brand that when they want a transaction, it's going to work. They don't know all these underlying technologies and services and utilities that the blockchain layer ones are providing. But at the end of the day, they know that, hey, if I'm buying this particular token, I'm going to receive it. If I want to trade it, I'm going to trade it. They're actually operating more on a layer 2 level, which is just a normal way of doing business. And I think all of us, here on especially the blockchains, are trying to get to that level where it's invisible in terms of the services you're providing, but the brand kind of guarantees to them that what they want selfishly is going to actually be achieved. And I think at the end of the day, that's what we're looking for. Yeah, and interoperability, so it works.
Yeah, most people didn't have any idea what Intel Inside meant other than they thought it was good. Right. Kevin, give us kind of your closing comments as we're a little over time, but it's been great having all of you. Kevin, go ahead. You're our closer.
I mean, it's great. Bitcoin is still, what does the ledger want from its users? Whereas Hedera, Polygon, and Accumulate are all, what do users want from our ledger? And that's the transition that we're in now. And yeah, and it's just real exciting to talk to all three of you.
What a pleasure to have all of you. We'll invite all of you back. We'll do this some more. Thanks all for the listeners. We didn't get to go through questions. Henry, thanks for that question. John Tradesman, thanks for answering it online. It was good to have everybody. God bless you guys. Bye-bye.